Hello, everyone. Today's class on International Financial Management, Unit 6, Market for Currency Options. In this chapter, terminologies, when and how they're all used, hedging with currency options, speculations, etc. Now, currency options and its market, ever since globalizations and liberalization, the Indian economy has led to an increase in the quantum of transactions in the foreign exchange market. This affects the balance sheet of the value of the firms and its assets and liabilities, accounts payable, accounts derivatives, market to provide a combination of hedging instruments for effective management of foreign exchange exposures. Currency derivatives are an instrument which is emerging with a significant interest shown by the prospective investors. Allowing these currency options in Indian stock market will now provide an opportunity with which also considers a view on exchange rate, fulfill the both investments and hedging objectives. These currency options provide another unique mechanism for dealing with fluctuations in these exchange rates. So the meaning behind the technical meaning of currency option is it is an agreement wherein buyer gets the right to buy and seller gets an underlying foreign currency in exchange for their base currency, which may be its home currency, like an Indian investor selling it in home-based currency, INR, as again as the exchange rate of another, foreign currencies. The exercise price, which is the exchange rate between two currencies, may be expressed in terms of base currency per unit of foreign currency. This is converted to base currency. If you are an Indian investor trying to get into an exchange, then the base currency, home currency, that's INR, will be considered for calculating and for further calculations. This currency options market exists normally at the organized exchanges. In the yesterday's class, we have learned about the organized stock exchanges like NSE, BSE, where there is the OTC option for them. Now, moving on to learn about the features of currency options. These are highly flexible, which means that the instruments can be made as per the requirement of the writer and the user. It is a combination of various features of forward and future contracts. Down payment. The down payment is all about suppose in option holder does not exercise his option, he has to forego the premium. Otherwise, the premium will be deducted from the total payoff in calculating the net payoff due to the option holder. Now, settlement is another feature of currency options wherein the option is exercised till maturity, then the agreement automatically lapses and there is no settlement required. This option contract gets terminated either on its time or by the option holder or maturity, whichever is earlier, it gets expired. So settlement has no requirement. Next is non-linearity, which means that the option holder's profit when the value of the underlying asset moves in one direction is not equal to his loss when its value moves in the opposite direction by the same amount. This basically means profits or losses which are symmetrical in an option contract. This conveys the non-linearity function exists in the currency options. Next feature we have underlying assets. The use and popularity of options is growing, and a wide range of underlying assets for which options exist, these days is one of the reason for the growing demand for the options. Option is a derivative security wherein a contractor giving the owner or say buyer has the option to buy or sell a defined set of quantity or a defined set of asset. Then strike price. What is strike price? It is a price for which the options owner can buy and sell the underlying security. It is a price which is agreed upon the transaction where the buyer decides and the seller okays with the price which is fixed. That price we refer it as strike price. Then we have expiration date. Expiration date is a date which is defined as a fixed during its whole life. Okay, where the option will not be able to change or move. Now, if this option is not exercised before or on the date of expiration, it becomes expired automatically. Then we have American versus European options. In such cases, wherein an American option can be exercised in its whole tenure from the moment, that is the day when it is expiring, it is counted as an expiration date. Whereas in European option, only at one single moment, that is the moment it is expiring, is exercised. Okay, then we have call option and put option. Basically, under options, we have two types of currency options, which are referred as call and buy. A call is wherein a foreign currency is purchased, bought, and put is to sell. Remember, call is to buy an option for in foreign currency. Put is an option to sell the foreign currency. Next, we have parties to option contract. In case of parties, we have here two parties. One is option contract buyer and the seller. There are two parties involved, buyer and seller. The buyer of an option is termed as holder, whereas the seller is called as writer or grantor. Okay, so we have the characteristics or the features of currency options under being highly flexible, down payment, settlement, non-linearity, underlying assets, followed by strike prices, expiration date, American versus European, call option and put option, parties to options contract. Moving on to the next topic, types of options. Now, after understanding the various features of options, let's now get into knowing the various forms, types of options which are available for the investors. This is generally based on certain natures. Nature of exercise, nature of market, nature of underlying assets. So, nature of exercise. Now, as we have learned under one of the feature, American versus European, that based upon American and European, the exercises expiration date differs. On the same lines, types of options are also defined. based on the timing of the exercise, when this is happening, the option can be either American or European. American option is, is an exercise at a point of time before the date of expiry, whereas European option is only at the time of expiry. I repeat, American is on or before the date of expiry. European is only and only at the time of maturity. Next, we have market. Now, based on market, we have certain methods, and that is OTC, that is exchange traded over the counter. And then we have OTC. These are like forward contracts, which are specified and recognized by two parties, buyer and seller. Again, these are prone to even mutual obligation negotiations also. Exchange traded options are like futures, which are to be bought and sold at a specific exchange, wherein two contracting parties may be known to each other, but instead they enter into a contract through the exchange. Nature of underlying asset. Options on stocks, indices, commodities, currencies, and interest rates are available. And these are the various several assets as referred as underlying. Either OTC or exchange options are all available on various currencies such as US dollars, euros, yen, pound, and other major exchanges in the USA, European countries, etc. Then we have next topic as options terminology. Now, these are the various terms which we often use in the currency options. And one is supposed to be well versed with these terminology, because we often throughout this international financial management say we use this. So hence it is considered to be the most important part to understand the terminology, because often we use it. So hence one is supposed to learn and understand it for the better understanding of the subject. One, call option. As just discussed, call options are the right to buy a specified quantity of the underlying or a fixed exercise price before the date of expiration. Pull option is right to sell. Remember, call is buying, pull is selling. Call option means before the expiry date, and put option is on or before the date of expiry. European style and American style, which are also discussed at the characteristics of options. European style is an option which is exercised only on the date of expiration, whereas American style is at any time before the expiration date. Strike price or exercise price. Strike price is the price which is when the contract is used when the contract is settled. It is the base for determination of the amount of cash the option holder is entitled to receive upon exercise. Strike date, maturity date, expiration date. This is the date on which the option expires. and the option holder shall no longer have any right on the option and no value. Next, we have at the money. This means that the current market value of the underlying is the same as the exercise price of the option. In the money, at the money, in the money. In the money means it is said to be in the money if the current market value of the underlying is above the exercise price of the option. Here, a put option is said to be in the money if the currency market value is underlying below the exercise price of the option. Out of the money. A call option is said to be out of the money if its underlying price is below the exercise price of the option. A put option is said to be out of the money if the current market underlying above the exercise price. The payoff profile of option is given for our better understanding. Here, there are three cases: in the money, at the money, out of the money. In the money, under call option is wherein spot rate is greater than strike rate. Put option is less than the strike rate is less than the spot. At the money is spot rate is equals to strike rate. Also put option, strike rate is equals to spot rate. Out of the money is wherein the spot rate is less than the strike rate, whereas under put option, it is less than the spot rate. Next terminology is intrinsic value. It reflects the amount with which an option is in the money. For call options, if there is a difference in the underlying stock price and the strike price, for put option, it is a difference between strike price and the underlying stock price. Next, time value. It's an option which exists because of the spot rate of the underlying currency is expected to move towards the money position between signing of the contract and the maturity date. Now, long and short. What is long and short refer here? It is a position as the holder of an option. Short refers to a position as a writer, whereas long as a position. Opening transaction, closing transaction. Opening transaction is a purchase or a sale transaction by which a person increase a position either as the holder or the writer of an option. Whereas a closing transaction is wherein a person reduces or cancels out previous positions either as the holder or the writer of that option. Next, we have option premium. It is the price that the holder pays and the writer of an option receives. Option holder, the person who buys the rights of an option is called option holder, the one who is buying. Option writer is the person who sells. And assigned exercise to perform according to the terms of the options. He is called as a writer. Assigned writer. He is assigned an exercise for writing, and so he is referred as assigned writer. All right. So here the various terminologies which are often used All of you should be well versed with this. Call, put options, European style, American style, add the money, in the money, out the money. See, if you are clear with this, it helps you to better easily understand the whole subject. Otherwise, you get stuck at understanding. Next, we have gains or losses of the option traders. Now, with the above terminologies which were used to understand, the same terminologies which we happen to understand can be used to explore this subject more. Firstly, call option. Call option, what is call option? It is the option buyer gaining if spot price is more than the strike price. This, if put up in the formula model, then we have call option buyer's gain is equals to spot rate minus strike rate minus premium. Now there is one small example discussed here. A Limited buys 1 month call option, exercise INR $68.23 along with a premium of INR 0.03 for USD. If the spot rate is maturity is INR 68.53 USD dollar, assume the lot size is USD 1000. The gain to A Limited will be calculated here. 68 minus 0.53 minus 68.23 minus 0.03 into 1000 is the amount, quantity. So here we get INR 270. All right. So now we have put option. What is put option? The buyer will let the option expire if the spot rate is greater than the strike price. The same thing is put up in the form of formula. And this formula can be used to simplify and identify the gain or the loss for the call option and put option. The formula here is the put option buyer gains is equals to strike or exercise rate minus spot rate minus premium. All right. So here we have few illustrations. Option buyer's gain or loss to be calculated. A dollar option contract as a strike rate is given. Spot rate on maturity is given. We are asked to calculate gain or loss. These are all very simple, simplification problems. The only thing is you all have to be well equipped with the terminologies, what they are. If you understand that, it is quite easy for you all to solve the problems. In the meaning itself, the simplification is presented. Now, next topic, determinants of option pricing. What are the various determinants of option pricing? Here, this right is not free of cost, option pricing. The option holder pays the consideration in the form of premium to the option writer. And in this process, there are few determinants to value the currency options. And these are so-called sensitivities because of which the currency value is sensitive and hence may lead to the fluctuations in the option prices. Let's see what are those. The first one is changes in forward rates. Spot rate changes, that's delta, time to maturity, theta, and impact of changing volatility is lambda. Change in forward rate is the first factor which influence on the value of the option. This is a forward rate sensitive because of its standard foreign currency options which are priced around the forward rate. It gives an important indication as to how the future exchange rate will move because the rate is determined after consideration the interest rate. Next, we have spot rate changes, which is termed as delta, also termed as delta. This rate is likely to change in the spot rate. It has a direct impact on time value of option. The sensitivity of the option premium to a small change in the spot rate exchange rate is called delta. That small change which happens with the change in the option premium is referred as delta, which is equals to change in option premium upon change in spot rate. Next, we have time to maturity or theta. The option values vary with the length of time to maturity. Longer the period of maturity, the greater is the option value. And vice versa. The expected change in the option premium from small change in the time to expiration is called as theta. And this is put it up in the formula as theta is equals to change in premium divided by change in time. Impact of changing volatility. Volatility is here defined as a standard deviation of daily percentage change in the underlying asset, underlying exchange rate. If the exchange rate's volatility is rising, then the risk of the option being exercised also will increase. And the formula here to calculate the lambda is equals to change in premium divided by change in volatility. This is viewed in three ways: historic, forward, and implied. Historic is concerned with the recent time period. Forward is drawn on the expected reflection of future time. Implied is backed out on the market option itself. And the thumb rule is to believe that it will fall significantly in near term when will sell options, hoping them to pay back, buy them back for a profit immediately after the volatility fall and cause option premium to fall. Next, we have change in the interest rate differentials, rho and pi. The expected change in the option premium from small domestic interest rate is called rho. On the other hand, expected change in the option premium from small change in the interest rate, foreign interest rate, is called pi. And the formulas are rho is equals to change in premium divided by change in domestic interest rate, whereas pi is change in foreign interest rate. Rho is about change in domestic interest rate, whereas pi is change in foreign interest rate. All right. Next, we have alternative strike prices and option premium. Now, here the volatility of the alternative strike prices is the market, and selecting the same is playing an important role in decision making. The strike price has more option premium, which will be examined, and a final strike price will be selected. The important thing here is to choose. To choose OTC, firm purchasing option in the over the counter market, and choose its own strike price. Then hedging with currency options. Currency option is another derivative instrument. Yesterday also under the chapter 5, we have learned about various currency options, hedging of currency options. Again, we have various options here, which is a derivative used for hedging foreign exchange risk. Foreign trade generators, short-term receivables and payables in foreign currency, because there is a few months lag in receiving and payable in such transactions. And so the role of hedging emerges. Hedging through purchase of options. Now, when in order to hedge foreign exchange risk, importers buy a call option and the exporter buy a put option. Hedging through purchase of options what happens is the foreign exchange risk is hedged. Importers buy a call option and the exporter buys a put option. The importers will not exercise the option because the obligation will be lower even after paying the premium. Next, we have hedging through selling of options. This is basically advised when the volatility in exchange rate is expected to be marginal. In this, the importer sells a put option and exporter sells a call option. See, in the above, it is importer buys a call option and exporter buy a put option. Whereas in hedging through selling options, importer sells a put option and exporter sells a call option. Okay, so very small difference, thin line of difference, which one has to understand: hedging through purchase of option and hedging through selling of option. Okay. Next, we have tunnels, simultaneous purchase and sale of options. Basically, tunnel means combining all put and call options. They're all put together. Or together buying and selling of options is called tunnel. All, buying and selling happens, everything, at one. The importer buys an out of the money call and sells an out of the money put option. Now, as a result, neither the call nor the put option is exercised if the exchange rate moves within a narrow margin. Here, the premium to be received on the sale of the put must be enough to cover the premium to be paid on the purchase of the call option. The exporter, when buys a put and sell a call, both out of the money, if the exchange rate moves within a narrow margin, the premium received covers the premium paid. But if the currency depreciates, then the put option is there to guarantee minimum price. Okay. And then moving on to the next topic, speculating with currency option. Speculation is nothing but the anticipation. In almost every class, this word we are hearing, speculation, it's all about anticipation. The moment in the currency exchange rates provide opportunities for speculative transactions, currency options, both call and put may be used for speculative gains. The speculative strategy depends on the expectations of the future movements in a particular currency. Speculating with currency call options. Now, one by one, let us understand. It is wherein a speculator purchases a call option on a foreign currency and anticipates an appreciation in the value of currency. And in this course, he adopts a routine, alternative route to book profits. Now, the speculator requires a call option by paying a premium, which depends on the intrinsic value and time value option. Okay. Next, speculation with currency put option. Put option or sell option depends on the views regarding future movements in the exchange rates. If the currency appreciates, the speculator puts option will not be exercised, and the speculator retains the premium received as his profit. The option will give the speculator the right to sell dollars at a specified strike price on a specific date. A speculator here who expects a currency to appreciate may sell put options on that currency. Okay. Now, we have speculation with a combination of call and put. Under this, the speculator combines both call and put, and such a combination are of two types, straddles and strangles. Again, there are two terms which you all have to understand, straddles and strangles. What is the straddle? The former involves the same strike price. The straddle involves the same strike price and maturity date, and the later, the strangles involve the strike price and expiry differs in the combination. So when the currency depreciates, the put generates profit and the call is not exercised at all. The gain is equal to the profit on the purchased call minus here the premium paid on the purchased put. Now look at what is strangle. It's a simultaneous purchase of call and put or the simultaneous sale of call and put. The call and put used in the combination will have different exercise prices. The buyer of strangle takes a view that exchange rate volatility should be high, while the seller expects low volatility. The long strangle holder will benefit from substantial movements in exchange rates in either directions. The combination of options here are presented here. You can see in this table. Tunnel, spread, vertical spread call, vertical spread put, horizontal spread call, horizontal spread put, diagonal spread call, diagonal spread put, long straddle, short straddle, long strangle, short strangle, long butterfly and short butterfly. All these are the various combinations of options. All right. So we have here a few examples. to be discussed. Very simple. You need to calculate using the formulas discussed in the chapter. Okay. So in this today's class, you learned about the various features, determinants, terminologies used in options. I repeat, terminologies one has to be very fully equipped with. Under short answer questions, you have various terms which have been discussed in the class. Short answer types. Then we have long answers wherein detailed discussions on speculators, exporters, hedging, importers, hedging, currency options can be discussed. Determinants, features, characteristics are also considered as long. All of you can focus on preparing yourself on these lines, followed by some problems, very simple calculations, provided if you know the terminology and the various formulas which have been presented in the theoretical background, in the content. If you follow simply and know how simple simplifications can be adopted, plus minus or product or division, which can be easily done. Followed by, you have exercise questions where 5 questions are there which you can choose to check your progress. All right. So with this, the unit is done. International Financial Management. Unit 6, Market for Currency Options. Thank you. Happy learning.